A 10K is the SEC-mandated annual report that gives investors a full picture of a public company's performance. Think of it like a multi-chapter book. Cover page and table of contents, quick reference to where everything lives. Business Overview Item 1 describes what the company does, its products, markets, and competitive edge, similar to a company's elevator pitch. Risk Factors Item 1A lists potential threats such as regulatory changes and supply chain disruptions. It reads like a what could go wrong checklist. Selected Financial Data Item 6, a 5-year snapshot of key numbers such as revenues, net income, and assets. Think of it as a high school report card over time. Management's Discussion and Analysis MD and Item 7, narrative where managers explain the numbers, trends, and future outlook. Comparable to a coach's post-game analysis. Financial Statements and Supplementary Data Item 8, the core statements such as income, balance sheet, cash flow, plus an auditor's report. These are the raw data that accountants love. Quantitative and qualitative disclosures about market risk Item 7A shows how interest rate, foreign exchange, commodity, or credit risk could affect cash flows. Controls and Procedures Item 9A describes internal controls over financial reporting, similar to a kitchen's hygiene checklist. Other information Item 9, miscellaneous items like legal proceedings, acquisitions, or shareholder votes. Exhibits and Financial Statement Schedules Item 14, contracts, bylaws, and detailed tables that back up the numbers. Understanding this structure helps you locate the information you need quickly, just as knowing the chapters of a textbook lets you find the relevant section for an exam. Explanation. The income statement, also called the profit and loss statement, records a company's revenues and expenses over a period showing whether it made a profit. To analyze it, top-line revenue is like the total tickets sold for a concert. It shows demand. Cost of goods sold, COGS, is the cost to produce those tickets, venue rental, performers. Subtracting COGS from revenue gives gross profit. Operating expenses, SG&A, R&D, are the backstage costs, marketing, salaries, research. Subtracting them from gross profit yields operating income, EBIT. Interest and taxes are like the venue's share of ticket sales and a sales tax. Net income is the final profit left for shareholders. Common size analysis converts each line item to a percentage of revenue, making companies of different sizes comparable. Mathematically, common size percent equals line item amount divided by total revenue times 100. Example, if revenue equals $500 million and COGS equals $300 million, then gross margin equals 300 divided by 500 times 100 equals 60%. A 60% gross margin means 60 cents of every revenue dollar is spent on production, leaving 40 cents to cover other costs and profit. By comparing the common size percentages across years or competitors, you can spot trends, for example shrinking margin, or advantages, for example lower SG and a percent. The balance sheet is a snapshot of what a company owns, assets, and owes liabilities at a point in time, with the difference being shareholders' equity. To evaluate it, focus on two groups of metrics. Liquidity tells you if the firm can meet short-term obligations, like checking if you have enough cash to pay your monthly bills. Current ratio equals current assets divided by current liabilities. A ratio greater than 1 means more short-term assets than short-term debt. Quick ratio, also called acid test, equals cash plus marketable securities plus accounts receivable divided by current liabilities. This removes inventory, which may be hard to turn into cash quickly. Solvency gauges long-term financial health, akin to asking whether a household can afford a mortgage. Debt to equity D/E equals total debt divided by total equity. High D/E indicates reliance on borrowed money. Interest coverage ratio equals earnings before interest and taxes divided by interest expense. Shows how many times earnings can cover interest payments. A low number, less than 1.5, signals risk. Debt to assets equals total debt divided by total assets, indicating the proportion of assets financed by creditors. By calculating these ratios and comparing them to industry averages, you can judge whether a company is financially stable or walking on a tightrope. Example, if a firm has current assets 200 million, current liabilities 150 million, cash 50 million, receivables 100 million, and inventory 50 million, then current ratio equals 200 divided by 150 equals 1.33. Quick ratio equals 50 plus 100 divided by 150 equals 1.00. Both suggest the firm can meet its short-term bills, but any drop in receivables could tighten the quick ratio. The cash flow statement shows how cash moves in and out of a business, divided into three parts. Operating activities, cash generated from core business, for example, cash collected from customers minus cash paid to suppliers. Think of it as the cash you earn from mowing lawns if you own a landscaping firm. Investing activities, cash spent on long-term assets such as plant, equipment, acquisitions, and cash received from selling them, like buying a new lawn mower or selling an old one. Financing activities, cash raised from issuing debt or equity or paid back to investors, such as dividends or debt repayments, comparable to taking a loan to buy the mower or repaying it. Free cash flow, abbreviated FCF, is the cash left after maintaining or expanding the asset base, and it is the money available to shareholders or to pay down debt. The typical formula is free cash flow equals operating cash flow minus capital expenditures, If a company generated $120 million of operating cash flow and spent $30 million on new equipment, its free cash flow equals $90 million. Positive free cash flow signals that the firm can fund growth, buy back shares, or reduce leverage without needing external financing. Decomposition example. A firm reports net income $50 million, depreciation $10 million, which is a non-cash add-back, and change in working capital negative $5 million, which is a cash outflow. Operating cash flow equals $50 million plus $10 million minus $5 million equals $55 million. If capital expenditures equal $20 million, then free cash flow equals $35 million. Analyzing each component reveals the quality of earnings. A firm that reports high net income but low operating cash flow may be using aggressive accounting tricks. Ratio analysis condenses the three financial statements into meaningful performance indicators. Each ratio belongs to a category. Profitability ratios measure the ability to generate earnings. Gross margin equals gross profit divided by revenue. Operating margin equals EBIT divided by revenue. Net profit margin equals net income divided by revenue. Return on assets (ROA) equals net income divided by average total assets. Return on equity (ROE) equals net income divided by average shareholders' equity. Higher percentages indicate better profitability. Efficiency activity ratios show how well assets are used. Asset turnover equals revenue divided by average total assets. Inventory turnover equals COGS divided by average inventory. Receivables turnover equals credit sales divided by average accounts receivable. These ratios illustrate the speed of converting assets into sales. Leverage solvency ratios assess financial risk. Debt to equity equals total debt divided by total equity. Debt to assets equals total debt divided by total assets. Interest coverage equals EBIT divided by interest expense. Higher leverage can amplify returns but also raises bankruptcy risk. Market ratios reflect market perception, useful for equity analysts. Earnings per share (EPS) equals net income divided by shares outstanding. Price to earnings (PE) equals market price per share divided by EPS. Dividend yield equals annual dividend per share divided by market price per share. Interpretation example. A PE of 15 may be considered reasonable in a mature industry, while a PE of 30 could suggest growth expectations or overevaluation. Interpretation tips. Compare ratios to industry averages and the firm's historical trend. Look for consistent patterns. For example, rising ROE with stable ROA may indicate better leverage use. Beware of single-point spikes. Verify underlying causes. Mathematical example for ROE. If net income equals $25 million, beginning equity equals $100 million, Ending equity equals $120 million. Average equity equals open parenthesis $100 million plus $120 million close parenthesis divided by 2 equals $110 million. Rho equals $25 million divided by $110 million equals 22.7%. This tells shareholders they earned roughly 23 cents for every dollar of equity invested. Notes to the financial statements are the fine print that explain the numbers in the 3 main statements. They are crucial because they disclose accounting policies - the rules the company follows, for example, revenue recognition and inventory valuation. Think of them as the recipe used to bake a cake. 2 chefs may use different recipes, resulting in different flavors even if the ingredients look the same. Example, a software firm using percentage of completion versus completed contract method will report revenue at different times. Contingencies and commitments - potential liabilities that may materialize, such as lawsuits and warranties. This is like knowing a car has a pending recall. The cost is not on the books yet but could hit later. Segment information - breakdown of revenue, profit, assets by business line or geography also appears in a separate section but reiterated here. Subsequent events - significant occurrences after the balance sheet date but before filing, for example, a major acquisition. Similar to a last-minute change in a movie's plot after filming wraps. Derivatives and hedging - details on fair value measurements and risk management strategies. Share-based compensation - description of stock options and how expense is calculated. Reading the notes helps you understand why a figure looks the way it does, and it often reveals red flags, for example, aggressive revenue recognition, large undisclosed legal reserves. Always cross-check the footnote disclosures against the headline numbers. The MD&A is the narrative heart of the 10K, where management explains past performance and future outlook in plain language. Identify key drivers, look for what managers say move the business, for example, price increases, volume growth, cost cuts. Ask, do the drivers match the numbers in the financial statements? Trend consistency. Compare year-over-year changes discussed in MD&A with the actual changes in the income statement and balance sheet. Inconsistencies may hint at selective storytelling. Forward-looking statements. Evaluate the realism of forecasts and strategic plans. Are they supported by data, for example, market size, pipeline of products? Watch for vague language like we expect continued growth without quantification. Risk discussion. See whether the MD&A repeats the risk factors or adds new ones. Missing discussion of material risks could be a warning sign. Capital allocation. Examine how the company plans to use cash, pay dividends, repurchase shares, invest in research and development. Compare this to the free cash flow computed earlier. Benchmarking. Managers often benchmark against peers. Verify those benchmarks using external data. Tone and language. Overly optimistic language, for example, exceptional results, may mask underlying issues. Overly defensive tone can indicate pressure. Analytical technique example. Create a 2-column table. One column lists MD and stated drivers, the other shows the corresponding quantitative impact. For example, higher pricing corresponds to plus 5% revenue. Cost-saving program corresponds to minus 3% SG, and A if the numbers do not line up, dig deeper. Segment reporting breaks down a firm's results by business line or geography, allowing analysts to pinpoint where value is created or lost. The 10K usually presents revenue, operating income, assets, and sometimes capital expenditures for each segment. Geographic breakdown, for example, North America, Europe, Asia Pacific. One performance attribution. Determine which segment contributed most to growth. Example, if total revenue grew 10%, but the European segment grew 25%, while North America fell 2%, the growth is driven by Europe. 2. Margin analysis. Compute segment. Operating margin equals operating income divided by revenue for each segment. Low margin in a segment may indicate higher competition or cost structure issues. 3. Trend spotting. Look at multi-year segment data to see shifts, for example, a tech company moving revenue from hardware to cloud services. 4. Risk assessment. High reliance on a single geography can expose the firm to political or currency risk. Use the currency exposure note to gauge impact. 5. Capital allocation efficiency. Compare segment capital expenditures to segment operating cash flow to see if investments are generating returns. Real-world analogy: imagine a restaurant chain with locations in 3 cities. Segment reporting is like getting separate profit and loss statements for each city, helping the owner decide whether to open more stores in the high-performing city or close the underperforming one. Practical step: create a simple spreadsheet with rows for each segment, columns for revenue, operating income, margin, and growth. Rate. This visual aid makes attribution fast and clear. Company X reports a net income of $40 million on revenue of $200 million, 20% net margin. Its cash flow from operating activities is only $10 million. The notes disclose a $30 million increase in accounts receivable. What potential issue should you investigate? The large gap between net income and operating cash flow suggests earnings quality problems. A $30 million rise in receivables indicates that much of the revenue may not have been collected, possibly overstating sales. Aggressive revenue recognition. Investigate the allowance for doubtful accounts and the aging schedule of receivables. A firm has cash $15 million, marketable securities $5 million, accounts receivable $20 million, inventory $30 million, current liabilities $50 million. Compute the current ratio and quick ratio. Current assets equals 15 plus 5 plus 20 plus 30 equals $70 million. Current ratio equals 70 divided by 50 equals 1.40. Quick assets equals 15 plus 5 plus 20 equals $40 million. Quick ratio equals 40 divided by 50 equals 0.80. The quick ratio below 1 signals potential short-term liquidity strain if receivables cannot be quickly turned into cash. Company Y provides the following, all in millions. Operating cash flow $120 million. Capital expenditures $45 million. Net income $70 million. Average invested capital $400 million. Calculate free cash flow FCF and return on invested capital ROIC. Free cash flow equals operating cash flow minus capital expenditures equals 120 minus 45 equals $75 million. Return on invested capital equals net income divided by average invested capital equals 70 divided by 400 equals 0.175 or 17.5%. Interpretation: an FCF of $75 million shows strong cash generation after reinvestment. A ROIC of 17.5% exceeds typical cost of capital, often 8 to 10% for many firms, indicating the company creates value